Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China State Construction International Holdings Limited annual report. China State Construction International Holdings Limited is a diversified construction company that provides a wide range of services to various sectors. At its core, the company engages in construction projects for private and public sectors, including toll roads and bridges, houses, buildings, hospitals, and schools. In addition to construction, China State Construction International Holdings Limited also offers civil engineering services, mechanical and electrical engineering works, foundation engineering, general contracting, prefabricated construction, and industrial plant reconstruction. The company's expertise extends to project management, subcontracting, and insurance brokerage services. The company is involved in various other businesses, including the design, manufacture, and installation of curtain walls, aluminum windows, and related products. It also sells and distributes construction materials, issues guaranteed notes, holds trademarks, leases plant and machinery, generates heat and electricity, and manufactures building-integrated photovoltaics curtain walls. Furthermore, China State Construction International Holdings Limited engages in marine engineering works, property investment and management, infrastructure operation and investment, thermoelectricity, toll road operation, property development, and facade contracting. The company's extensive range of services makes it a significant player in the construction industry globally. China State Construction International Holdings Limited market capitalization of $48 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that China State Construction International Holdings Limited holds a significant advantage in their industry. China State Construction International Holdings Limited trades at a lower price-to-earnings ratio of 5 times and a lower price-to-book ratio of 0.6 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 6.24%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for the company can be identified through an analysis of various factors. On the growth side, notable contributors include a surge in goods exports in Hong Kong, successful project launches in multiple Chinese provincial capital cities, and increased recognition of MiSi products in first-tier cities. The company's winning bids for large-scale projects, such as Galaxy Macau's Phase 4 Stage 2, also contributed to revenue growth. Additionally, the steady economic growth in China, driven by innovation-led development, and the group's technological products showcased at high-profile exhibitions have been significant drivers of revenue growth. Furthermore, the company has seen a notable increase in revenue from Chinese mainland investment businesses, exceeding 100% for the first time. The signing of technology-driven contracts worth Rm 85,389 million, representing a year-on-year increase of 6.2%, has also contributed to revenue growth. On the other hand, there are no explicitly mentioned drivers of revenue decline in the report. However, some segments have experienced decline, including the Macau segment, with a minus 30.4% decrease, and intermediate holding companies and joint ventures experiencing significant decreases in revenue from construction contracts. The financial performance of the company experienced a decline in net income by Rm 84 million. This decrease was largely attributed to a reduction in profit margins. A significant factor contributing to this drop was an impairment provision made due to unexpectedly poor business results. The provision highlighted the company's struggles with meeting its performance expectations, leading to a decrease in profitability. The company's financial performance has been a subject of interest for investors and analysts alike. A key indicator of its success can be seen in the generation of positive operating cash flow. This trend has been consistent over the past 4 years, with the company reporting a net inflow of RMB 1,053 million for the year. The data from various pages of the report confirms this positive trend. On page 32 and 34, it is stated that the company has generated positive operating cash flow for the 4th consecutive year. Similarly, on page 37, it is mentioned that the company has achieved a net inflow of RMB 1,053 million for the year. Furthermore, other pages of the report also support this conclusion. On page 40, it is reported that the operating cash flow was RMB 1,053 million, indicating a net cash inflow. Additionally, on page 132 and 134, it is stated that the net cash from operations was positive in both 2025 and 2024. In conclusion, the company's ability to generate positive operating cash flow for 4 consecutive years is a testament to its financial stability and success. This trend suggests that the company has been able to manage its finances effectively, resulting in a steady inflow of cash from its operations. The company's debt level has seen a significant increase from 2021 to 2025. Total borrowings rose by 46.8% over this period, while bank borrowings increased by 14%. Net borrowings also saw a notable rise of 28.3%. This substantial growth in debt levels is a key financial trend for the company. In contrast, interest expenses have decreased significantly from 2024 to 2025. The company's interest expenses dropped by 15.7% over this period, indicating a reduction in its financial burden. This decrease in interest expenses suggests that the company may be benefiting from lower borrowing costs or more efficient debt management strategies. The performance of various segments and regions within a company has been analyzed based on extracted summaries. It appears that certain areas struggled to meet expectations. Macau and Hong Kong were among the underperforming regions. Macau's segment revenue and results were significantly lower, at 3.6% and 2.1%, respectively. Similarly, Hong Kong's performance was inconsistent, with some pages indicating poor results in various sectors, while others showed strong growth in the construction business. On the other hand, the Chinese mainland stood out as a top performer. With segment revenue of 53.4% and segment results of 83.8%, it demonstrated impressive growth and success. This suggests that the company's focus on this region may be paying off, and efforts to expand its presence in China could continue to yield positive results. Management is optimistic about the company's outlook, highlighting several key areas of success and strategy. On page 10, management notes the win of a major bid for the Zhaoshan Yangdong Digital Marine Industrial Park project, demonstrating the company's ability to secure significant contracts. The company is also investing in innovative projects such as hydrogen energy applications and smart construction technologies, page 12. Additionally, the Fuyang Automotive Electronics Industry Base project will improve industry chain ecosystem and enhance industrial output, page 13. Management emphasizes the importance of adopting modular construction, receiving international certifications, and upgrading enterprise qualifications to enhance market competitiveness, page 22. The company has also made significant progress in implementing key national R&D projects and winning major science and technology awards, page 34. In terms of human resources, management is committed to a dual strategy of internal cultivation and external recruitment to bolster human resource reserves. The company is intensifying market promotion to drive the optimization of its business structure through technology-empowered development. The group has been actively participating in the construction of public houses in Hong Kong using MiSi technology, page 38. Management prioritizes investment quality, focusing on high-potential regions in the Chinese mainland. The company has also optimized project mix and increased participation in government-targeted repurchase projects to accelerate capital turnover. In terms of risk management, the group has effectively managed construction risks through centralized procurement and efficient control of material costs, page 97. Management will focus on core cities in overseas business to avoid political and regulatory risks. The company's infrastructure project investments are performing well, with no past due amounts as at 31 December 2025 and 2024, page 188. Overall, management is confident about the company's outlook, highlighting its success in securing major contracts, investing in innovative projects, and managing construction risks effectively. The company has made several key transactions through acquisitions and divestitures. In terms of acquisitions, the company has entered into two significant agreements. The COLI Supply of Materials Framework Agreement was signed on April 30, 2024, while the CSCC-LCSCD Facade Construction Contracts Framework Agreement was signed on October 31, 2024. These agreements are expected to have a positive impact on the company's operations. On the other hand, the company has also made divestitures. One notable transaction is the complete sale of its interest in a foreign operation. Additionally, the company has reduced its equity securities by 2544 units. These transactions demonstrate the company's efforts to optimize its portfolio and focus on core business activities. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. This indicates a commitment to rewarding investors for their loyalty and trust in the company. A review of the provided page numbers reveals that the company has indeed paid dividends on multiple occasions, as mentioned on pages 37, 86, 96, 130, 131, 138, 181, and 206. These specific details provide evidence of the company's dividend payments. In contrast, there is no record of share buybacks by the company. This suggests that they have chosen to allocate their resources towards other areas, such as investing in growth initiatives or maintaining a strong cash reserve. Concerns about inventory buildup and supply chain disruption have been raised in recent data. The increase in raw materials and consumables by 32% from 2024 to 2025 is a significant concern, as it may indicate an overstocking of essential components. Furthermore, the substantial rise in finished goods by 83% during the same period suggests that manufacturers are struggling to manage their inventory levels effectively. This buildup could potentially lead to supply chain disruptions if not addressed promptly. Although supply chain disruption is not explicitly mentioned, the mention on page 32 that disrupted the stability of global supply chains implies a potential vulnerability in the system. The combination of these factors raises concerns about the resilience of the supply chain and its ability to adapt to changing demands. That concludes the financial summary for China State Construction International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.